Imagine having a fortune of $129.2 billion. You might envision luxury yachts, sumptuous villas, and high-end sports cars. And yet, the man who owns this fortune, Warren Buffett, lives in a remarkably frugal manner. While most of us struggle to earn a decent wage, with only our group retirement savings plan for security, the iconic businessman is widely recognized for his ability to identify lucrative opportunities, close clever deals, and invest wisely. And although one might think there are no secrets left for accumulating wealth, a few surprising habits have allowed Mr. Buffett to amass so much capital in such a short time, as this is where his sharp financial wisdom comes from. What if I told you that some of these habits could be the key to transforming your own financial situation? In this video, we will dissect 10 financial habits that keep the majority of people chained to poverty, and how, by following in Buffett's footsteps, you can avoid these traps to embrace financial prosperity. Trust me, you can't afford to miss out on this information. Stay with us. According to Buffett, one of the most devastating financial habits that anchor people in poverty is living beyond their means. If there's one lesson we can learn from Warren Buffett, it's the vital importance of not living beyond your means. Buffett, often called the Oracle of Omaha, in recognition of his prodigious ability to forecast market trends and make wise investment choices, is the quintessential model of frugality. Omaha, the Nebraska city where he was born and where his company, Berkshire Hathaway, is headquartered, is proud of this citizen who has become an investment legend. Despite his colossal fortune, Buffett still resides in the modest home he purchased in 1958 for a mere $31,500. While many billionaires flaunt their wealth with lavish residences and extravagant spending, Buffett prefers to lead a simple, unostentatious life. And another of his habits is that you won't see him behind the wheel of an expensive sports car. Instead, he drives a 2014 Cadillac XTS, a choice well below what his bank account could allow. It was at the Berkshire Hathaway annual meeting in 2020 that Buffett best illustrated the importance of this habit. He said, "If you buy things you do not need, soon you will have to sell things you need." This maxim is a warning against the trap of excessive consumption. When you live paycheck to paycheck, every unforeseen expense can be a source of financial stress. Instead, by following Buffett's example, you can set aside a portion of your income for wise investments and create a financial safety net. This strategy favors the building of long-term wealth over the immediate satisfaction of consumer desires. After examining the vital importance of not living beyond your means, we move on to another pernicious financial habit, particularly insidious, that can sabotage your efforts to accumulate wealth: the accumulation of high-cost debt, especially credit card debt. The exorbitant interest rates of credit cards can turn even the most modest debts into insurmountable financial burdens, hindering your aspirations for financial independence. Warren Buffett understands this well and strongly advises against carrying a balance on credit cards. From his perspective of financial wisdom, high-cost debt is like a cannonball tied to your ability to accumulate wealth. For even with his immense fortune, Buffett has never encouraged excessive indebtedness. On the contrary, he has often emphasized the importance of avoiding debt, especially those at high interest rates. At the Berkshire Hathaway annual meeting in 2018, he presented a striking analogy about credit card debt. "I think credit cards are very useful, but I also think heroin is very useful to dealers. They can make a lot of money from it. If you use a credit card, do not consider it as a source of credit. Consider it instead as a very convenient form of transaction." In other words, the accumulation of high-cost debt is the financial equivalent of playing with fire. It's a habit that not only erodes your current wealth, but can also compromise your financial future. In the end, Buffett's message is clear. To ensure your financial prosperity, avoid unnecessary debt, especially when the cost of that debt is high. Avoiding high-cost debt is a key strategy for ensuring solid and continuous financial growth. Moving from the issue of high-cost debt, we arrive at another habit that prevents many people from reaching their financial potential: the lack of financial education. Much of Warren Buffett's incredible financial success is based on a deep knowledge and sharp understanding of financial principles. The Oracle of Omaha firmly believes in the importance of understanding what you're investing in. Conversely, a lack of financial knowledge can lead to poor decisions, and consequently, to devastating financial losses. Financial education is not just a nice-to-have, it's an absolute necessity for anyone aspiring to wealth. Buffett himself is a staunch advocate of financial education. In a 2013 interview with CNBC, he stated, "The biggest investment you can make is in yourself." It's clear that Buffett didn't accumulate his fortune simply by luck or chance. He has dedicated years to studying businesses, markets, and economic trends. This financial education equipped him to make wise investment choices and to understand the risks associated with each financial decision he makes. Unfortunately, many people make the mistake of diving into the world of finance without a solid understanding of how money and investing work. They rush into investment decisions without fully understanding the risks, or they get misled by promises of quick and easy returns. This can lead to costly and avoidable financial mistakes. Therefore, the more you know about how to manage your money, the more you will be able to make financial decisions that lead you to greater prosperity. Do not let a lack of financial knowledge be a barrier to your financial success. Instead, follow Buffett's example and invest in your own financial education. The fourth bad habit, according to Buffett, that can totally ruin your financial future is impulsive buying. Impulsive purchases, whether of stocks or consumer goods, can lead to disastrous financial consequences. Warren Buffett is a fervent advocate of thinking and thorough research before making purchases or investments. Buffett is not an impulsive man when it comes to spending or investing his money. He is famous for his diligence and thoughtful approach to investing, avoiding impulsive purchases that could lead to losses. Instead, he advocates for a measured and methodical approach to investments, taking the time to study and fully understand each opportunity before committing to it. In a letter to Berkshire Hathaway shareholders in 1996, Buffett wrote, "We don't try to jump over 7-foot bars. We look around for 1-foot bars that we can step over." This wise advice perfectly captures his cautious and thoughtful approach to investments. Furthermore, this philosophy extends to all aspects of his spending. Despite his wealth, he avoids extravagant or impulsive purchases. Instead, he values simplicity and frugality, two traits that have helped him accumulate and preserve his wealth over the years. Habit number 5, neglecting savings. The importance of saving money on a regular basis cannot be overstated in wealth building. The Oracle of Omaha is the perfect example of the importance of savings. He began saving and investing at a very young age, which was a key component of his phenomenal accumulation of wealth. It's important to understand that Warren Buffett did not become rich overnight. It's the result of decades of discipline in saving and investing. He bought his first stock at the age of 11 and saved money from his various childhood jobs. This early dedication to saving and investing laid the foundation for his incredible financial success. However, many people neglect saving. They find themselves living paycheck to paycheck, never setting aside money for the future. This short-term approach can lead to financial difficulties, especially in the event of unexpected expenses or emergencies. Buffett, in his many speeches and writings, has repeatedly emphasized the importance of saving. In a 2018 interview with CNBC, he said, "Do not save what is left after spending, but spend what is left after saving." This simple yet powerful advice illustrates Buffett's philosophy on saving and investing. So make saving a priority, and you will be on the path to greater financial prosperity. The sixth major pitfall that hampers wealth creation is the pursuit of quick wealth. The temptation to get rich quickly can be alluring. However, Warren Buffett has repeatedly expressed his disapproval of speculative investments and the pursuit of get-rich-quick schemes. Instead, he advocates a long-term investment approach. Buffett is not a follower of day trading or other forms of quick speculation. He does not engage in risky transactions in hopes of a quick gain. Instead, he prefers to focus on solid companies with proven business models that he can understand and monitor over the long term. His philosophy is that it is better to invest in quality companies at reasonable prices and let time do its work. In a letter to Berkshire Hathaway shareholders in 1996, Buffett wrote, Our favorite holding period is forever. These words perfectly sum up his long-term investment strategy and his reluctance to pursue quick, speculative gains. The lesson here is clear. The quest for quick wealth is a path fraught with pitfalls that can seriously harm your financial health. Instead, take the time to learn, invest in quality assets, and have the patience to let your investments grow over time. It may not be a quick path to wealth, but it is a much safer and more stable one. Seventh habit, ignoring the power of compound interest. The magic of compound interest is an open secret that Warren Buffett has never hesitated to share. He attributes a significant portion of his prodigious wealth to compound interest. Ignoring this powerful force can seriously slow down the accumulation of your wealth. Compound interest, often described as the eighth wonder of the world, is the process by which interest on your money begins to earn its own interest. This can have an exponential effect on the growth of your wealth over the long term. It's precisely this formula that Buffett has exploited throughout his career. In fact, Buffett began to capitalize on the power of compound interest from a young age. The money he saved and invested at the age of 11 continued to grow and multiply through the decades, contributing to his current fortune. At the Berkshire Hathaway Annual General Meeting in 2016, Buffett illustrated the power of compound interest by stating, "My wealth comes from a combination of living in America, some lucky genes, and compound interest. Compound interest is how you create wealth." Ignoring compound interest is one of the biggest mistakes you can make in managing your money. It is crucial to understand and leverage the power of compound interest if you want to multiply your wealth over the long term. If you take Buffett's advice to heart and start investing early and regularly, your financial future could resemble Buffett's own. The eighth bad habit is not diversifying investments. A fundamental principle of investing, endorsed by the Oracle of Omaha himself, is not to put all your eggs in one basket. It's a risky strategy. Warren Buffett has always advocated for diversification to spread risk, although he also believes in focusing on the most promising opportunities. Not diversifying your investments exposes your wealth to unnecessary risks. If one investment goes wrong, it can wipe out all your savings. It's like playing Russian roulette with your financial future. Buffett understands this principle well. Berkshire Hathaway, the investment company he leads, holds shares in dozens of companies across varied sectors, from insurance to manufacturing to energy and retail. This spreads the risk and ensures that if one sector or company performs poorly, the others can compensate. However, Buffett also has a nuanced approach to diversification. He believes in focusing on the most promising opportunities, investing heavily in companies he understands and trusts. Diversification is essential, but it must be balanced with deep knowledge and strong conviction in your investments. Neglecting to diversify can be a costly mistake that hinders wealth accumulation. Finally, the last and perhaps most delicate of all the bad habits is the impact of your emotions on your financial decisions. Warren Buffett consistently insists that you must keep control of your emotions when investing. Emotions, especially fear and greed, can cloud our judgment and lead to major financial errors. In the volatile arena of financial markets, it's natural to feel a surge of adrenaline or a twinge of panic. Greed can push you to invest indiscriminately when a market is booming, while fear can make you sell hastily when things start to collapse. Yet, it's precisely in these moments that you must resist these emotional impulses. The Oracle of Omaha has iconic advice on this matter. Be fearful when others are greedy, and be greedy when others are fearful. He lived by this principle during the financial crisis of 2008, when he made massive investments in companies like Goldman Sachs and General Electric, while most other investors were too scared to act. He followed his own logic, based on his understanding of the fundamentals of these companies, rather than on market mood. The result? Huge returns when the market eventually recovered. This is a key lesson. Allowing emotions to dictate your financial decisions can prevent you from accumulating wealth. It is crucial to master your emotions, remain rational, and make financial decisions based on careful evaluation rather than on fear or greed. Not doing so can be a major obstacle to wealth accumulation. And there you have it. We've just reviewed the 10 financial habits that, according to Warren Buffett, keep people in poverty. As we've seen, it is crucial to master your emotions, live below your means, beware of costly debt, educate yourself financially, avoid impulsive purchases, prioritize saving, not chase quick wealth, understand compound interest, diversify your investments, and above all, not let emotions guide your financial decisions. If you enjoyed this content and would like to learn more about the financial advice of the Oracle of Omaha, I invite you to click on the video appearing on the screen right now. We will break down even more of Warren Buffett's wisdom and explore how you can apply his principles to your own financial life.